Lemon Tree Hotels also in focus. They've been signing a whole slew of new deals in just September. I had the chance to speak with the chairman and managing director, Patanjali Keswani, on what the plan is. Take a look at that conversation.
I think our geographies, Tamana, are all over India because that's where we are focused. I think in H1 we've signed 21 hotels and about 1,500-1,600 rooms. And this is just the beginning. We have at least an equivalent amount planned for H2, and it's just accelerating. So this is really mostly managed hotels. That is that we provide the brand and the management, but we are also going to now aggressively expand our franchised uh, properties through the Keys brand. And I think that is going to be the really big play for us in the next 3 to 4 years.
So we could see maybe end of this year about 3,000 rooms signed, say about 250, 200 odd hotels maybe. And will this be evenly spread? Are there any specific locations that you're looking at?
So we have a two-pronged approach. One is that we have a lot of owners who directly approach us. So in that sense, it's a reactive approach. That we get people who want to sign with us, and wherever they come from, as long as we think we can add value, and we think we can add value everywhere, we sign those contracts. Then there is a proactive approach, which is where we think we need to be from a network perspective, where we see new airports opening, better connectivity with 4-lane highways, Vande Bharat trains, or new developments happening on the commercial front. So that's the proactive strategy. And we've identified, look, there are about a little under 200 rooms in India with more than 500,000 population. And with increasing urbanization, obviously this will increase. There are airports being announced for many new cities. So looking at from that perspective and to grow our brand and network, we go after those locations and try and get hotels there too. So it's both proactive and reactive.
We've also seen one other thing which is happening with the company as we observe, apart from the new signings, is a bit of a squeeze in margins in Q1. It's generally maybe a soft quarter. You had elections as well, but also because of renovation works going on. Give us a picture of whether most of that is now behind you.
So, as far as our own network goes, we own about a little under 6,000 rooms. Actually, we are, I think, the second largest owner of hotel rooms in India. And what happened is pre-COVID, we really had, from 2019, we had stopped renovating hotels. Because obviously, initially, it was due to COVID for the first couple of years, and the next year or two, it was recovering. So we realized we normally renovate 1/6 of our hotels every year. Think of it that over every 6 years, you have a new refreshed product in each of our hotels, owned hotels. But because we did not do it for 4 to 5 years, we had a lot of hotels that were very old. Whether it was the rooms, the public areas, the restaurants, the banquets. So we decided to very aggressively renovate this year, and we will do so next year too. In fact, even the preceding year, 2024. So in total, we are investing about 250, or I think 270 crores, of which about one third or 40% will be capex, but about 160 crores will be opex. What does this mean? It means that somewhere at the end of next year, calendar, we will have completely renovated all our old hotels, including the Keys portfolio, which was in really shabby state when we acquired it. And the new hotels, obviously, which we've opened, we will not need to renovate. So in synopsis, by next year, the entire owned portfolio will be completely new. And we think it's a good time because I think, and that's a view I have, that India is going to undertake or go through a structural shift in demand for branded mid-market hotels. And we are very much at that inflection point where China, Indonesia, and various other countries were at this point in household income.
No, so just to come to the number, the last was about 700 rooms were under renovation. Is that pretty much done? What would be the number currently and what we would see by Q2?
So every quarter we renovate about 700 rooms.
Okay.
So if you look at 6,000 rooms, about 1,500 rooms are new. That is, they opened in the year before COVID. That leaves 4,500. So we really need to renovate 4,500 rooms. We renovated, I think, about 700 last year. We're going to renovate 3,000 this year and another 1,500 next year, and that, or 1,000 next year. That'll take care of the entire portfolio.
Okay, so by FY26 you're done. Where does that leave you in terms of margins? Do you see margins remaining at the current levels that we saw in Q1?
No, we will do better because Q1 we had a squeeze on revenue. Fundamental. See, think of it this way, Tamana. H1 is normally the weak quarter.
Yes.
And we do in H2 we normally do 20-25% higher revenue because of rates and occupancy. So besides the fact that it was a weak, it is a typically weak quarter. We had elections, we had a heat wave, we had multiple other things happening together. So obviously occupancies and average rates were had kind of not a little less than one would normally expect in a Q1. But we invested a lot of money in renovation. So if you just take out the renovation expense, actually we didn't do so badly. Q2 we will do better, a few percentage points better than Q1, and I think you will see us go back to Q2 previous year similar margins this year.
Can you say that last bit again? You will see us going to which margins?
Similar margins in spite of massively increased expenditure in renovation.
Okay.
We'll do similar margins, which means without renovation, we would have done much better than Q2 last year.
Okay. In terms of, sort of appetite coming back, what is Q2 looking like since elections, etc., behind us? And we're also getting into festive season. There is this huge blockbuster wedding date bit also coming in. What are your expectations from all of that, and how do you see that panning out?
See, what I find, what I get confused about is the press constantly says that, in festive season, demand goes up, but actually it doesn't, it goes down. Because people, how many people do you know travel during Diwali or Dussehra? This is a time when people, hang out with family, hang out at home. So October, for example, this year has both Dussehra and Diwali. I think the last date is Diwali. So I think it will be normally Q3, while it is better than Q2. 1 month of that gets affected because of Dussehra, Diwali, and the last week of December because of Christmas and New Year. And the best quarter is always Q4. So if I looked at it, very rule of thumb kind of thing, Q1 is normally 22-23%, Q2 is 22-23%, Q3 would be maybe 26%, and 30% would be in Q4. So that's roughly how the revenue distributes itself over 4 quarters. And well, I don't see any reason why Q3 won't be good this year, although October will be as is normal, less than November and the first 3 weeks of December.
That's a fair point there. What about the kind of guidance you see, Mr. Keswani, for ARR, your RevPAR, those kind of metrics? You see that improving as more of your renovated rooms come back into stock?
So this year we should do, while our occupancies in H1 were kind of flat compared to last year, or maybe even marginally less because we had closed 700. See, when we say we are renovating 700 rooms, it means really we've closed 1,000 rooms because you cannot give a room to a guest next to a room that is being renovated or on a floor which is just below a renovated floor or a floor under renovation because there's a lot of noise. So about 20% of our inventory was shut in Q1 and 20% will be shut in Q2. But I think in spite of that, we did very, very well because our occupancies are, in that sense, close to 85-90% of the operating inventory. I see average rates growing at 5 to 10%, depending on the market. So an average of 7 maybe. But when our entire inventory opens as a fully renovated product, then I would be very disappointed if, assuming, of course, no unforeseen stuff, that our average rates wouldn't go up by 12-13%. And that means actually, a massive operating leverage for us once the full renovation is done.
Okay. By the last quarter, do you also expect inbound tourists to come back, and would that be then a big upswing? Because that's something we hear across the industry, and I'm wondering if that's something that you're penciling in as well.
See, I have always felt while we welcome, again, you're talking opportunistic versus strategic. Our business development has two elements: opportunistic, which is when somebody comes to us, and strategic, which is when we go after someone or some hotel. As far as customers go, when inbound picks up, it's opportunistic for us. It increases the occupancy of our hotels. But strategic for us has been domestic consumption, which is why I talk structural shift, because I think that the domestic Indian consumer for mid-market branded hotel rooms is poised to hockey stick up. And strategically, we are focused on that. Of course, international travel coming into India is a benefit, but I don't see that growing at the same rate, in spite of a much smaller base as domestic travelers, because that is where the real shift from discretionary to non-discretionary consumption of branded hotels will happen.
Just absolutely last question, sir, and it's about floor hotels. What are the plans for listing at a time when IPOs are being received pretty well? Is this the time to take the plunge?
100%. I have said this before publicly that we will list floor. It is the timing that I'm not certain about, but it will be sooner rather than later. And yes, it is very much under consideration. We are just looking at the various routes by which we can make Fleur a public company.
In this calendar year? Can we expect something this calendar year?
No.
Okay.
Calendar year is 6 months, Tamana. I don't think it's possible. We haven't filed a DRHP, nothing, so it's not likely.